in my whole period at the BIS, and if not before, been very concerned about the way in which monetary policy has been conducted, what I call the ultra-easy monetary policy. And this raises the question of what they call financial dominance, which is that the central banks now become afraid to raise interest rates or to maintain interest rates at high levels because they know that the society, the private society, is already so heavily indebted that if they keep the interest rates high, the bankruptcies start to mount, and all of a sudden you get a problem that you can't control. This is what Irving Fisher back in the 1930s referred to as the problem of debt deflation. For the first time in my memory, and it's very long in the central banking, people are starting to talk about whether the government can afford to pay the burden of debt service that's now associated with the level of debt. Private sector problem that's going to wind up with deflation. We get a public sector problem that's going to wind up with inflation. Now, which could it be? We will go back to a world in which threat of fiscal dominance will be met by the reality of financial repression.
Welcome to the Microscopic Podcast presented by GoldRepublic. My name is Alexei Joranov, and in this format I invite you to look at the world through different lenses, to see what's hidden in plain sight. I hope you will get fresh insight and enjoy this conversation. If you do, as always, please give it a like and subscribe, but also leave your actions down below in the comment section and share it to those who need to hear this. But before I start, I'd like you to know that if you open an account at GoldRepublic, you will receive 1 free gram of gold. Just click on the link in the description. It's a pleasure to have you, Bill.
Pleasure to be here.
So we've been introduced by David March, the chairman of the UMFIF, with whom we are also producing a documentary right now about the latest report called A New World Disorder.
Mm-hmm.
And it's interesting that we'll be able to talk to you because you've been, as I understood, for a long time working in central banks. So you started your career in the Central Bank of England, the Bank of England. And then later on went for quite some time also in the Bank of Canada, and then afterwards at the Bank of International Settlement, where you've been a manager in the monetary and economic department, if I'm not
I was the economic advisor and the head of the monetary and economics department.
All right, it's a long title.
Yeah.
So maybe it would actually be interesting to hear from yourself. How was your time? How did your career evolve? And what were, let's say, the most important events within that time?
Oh, shucks. Well, when I finished my PhD at the University of Manchester back in 1969, then I went to work at the Bank of England, and then I went back to Canada. And honestly, I was an aspiring politician. And I really had in my head that I would have a political career. And then we had the first energy price shock and then the second energy price shock. And I listened to many of the politicians saying stuff in Canada like, we're a net producer of energy, so this has got no implications for us, and thinking this was total nonsense. And that if this is what you had to do to be a politician, I said, I think I'll become a technocrat instead. So I subsequently had many, many years with the, as you put it, with the Bank of Canada, with the BIS. Then I spent 9 years, I think, at the OECD, just on a temporary basis as chairman of the Economic and Development Review Committee. So I've been around the official side really for my entire professional career.
So a lot of people know central bankers, but it's not always clear what they do. So my first question to you would be, what does a central banker do?
Well, I guess in principle, what a central banker does is try to monitor the monetary and financial system to ensure both price stability and financial stability. And that's the ultimate objective, it seems to me. So it's a kind of macroeconomic management issue, which of course central bankers have their own sort of special area, as it were, having to do with sort of control of money, finance. But clearly you have to work in some degree of concert with the government, fiscal authorities, because in the end, of course, in a democratic society, even a so-called quote-unquote independent central bank is really subject to the same rules as everybody else. That in the final analysis, the government is elected by the people, the government is sovereign. So independence, as it were, has its limits.
Mm. And that's actually, I think, also an interesting point, is that with a lot of commentators and also people I talk to, but also in the media or whatever, there's a criticism that central banks are either too independent or the fact that they should be dependent. And and I never quite get like some mixed stance on that. It's always one or the other, opposite. How do you experience that? What would, like, let's say, that imply, like this dependency?
Can a central bank be too independent? Can it be too dependent? I think, like many things in life, the Greeks had it right. That you want to tread a path that's sort of somewhere in between the two. And if you've got a degree of criticism from some people who say, you know, you're too much in bed with the government, and you're financing their deficits, that's a bad thing. And if you've got people that say you're too independent and you're following a path, for example, that makes the fiscal situation ultimately unsustainable, well, that's a bad thing too. So somehow you want to, you know, chart that narrow middle course to avoid sort of really bad things happening on both sides. Mm-hmm. But I can remember back at the Bank of Canada saying to the then governor, John Crow, when he was saying, we must be doing everything right because everybody says we're doing a great job. I said, John, this is an indication of the fact you've obviously got it wrong. If everybody thinks you're doing a good job, you've got it wrong.
On the other hand, there was also like this famous quote, if I remember well, from Alan Greenspan, who had famously, I think it was in the beginning 2000s, I'm not quite sure where to situate it, answering a question about a journalist who didn't understand.
Yeah. If you think you understand me, then I've obviously misspoken.
Exactly. And so that always fuels this very complex feeling of the role of a central bank, right? Yeah. From one side, doing things that are sensible to market participants for forward guidance, knowing what to expect in terms of monetary policy, but also for the general public to know and understand what is being done with the cost of money and thereby inflation.
Yeah. No, it's very odd because in the old days, I think central bank, this is even before my time, and I'm going back now to the 1950s and for centuries before that, the basic idea was never apologize and never explain. You know, so that just trust me, I'm a central bank and I know what I'm doing. And then almost overnight, that sort of hallowed shadows kind of stuff was replaced by central banks must be transparent. And I think that had a lot to do with the academic influence of models in which people had rational expectations, and so that people were expected to understand what the central bank was trying to do, and therefore they would change their behavior in a way that was consistent with what the central bank wanted. So the central bank would say, we have an inflation target of 2% or less, and everybody would say, well, inflation will be 2% or less, so therefore my wages should be 2% or less plus productivity increase. So the central bank's target had a definitive impact on what people did. They self-created the situation that the central bank wanted, But of course, they had to know what it was that the target was. So transparency became the centerpiece of the way in which central banks conducted monetary policy. I don't know whether there was ever any real test of where the ordinary citizens ever did grasp what the central bank was up to and what it was trying to do. I remember, I think this was a skit some time back, where in the skit they did a survey of the Federal Reserve. What is the Federal Reserve? And 50% of the citizens responded, it's a kind of high-class bourbon. There was a recent paper done by a guy called Jeremy Rudd in the International Department of the Fed that basically says there is no theoretical or empirical evidence to actually support the view that people's expectations about the target have an influence on their expectations about future inflation. It was a very powerful paper, quite recent. It does raise the obvious question, on what empirical or theoretical basis does your framework for conducting policy rest? And sometimes when you start to look into the framework, you realize that perhaps the foundations of that framework are not perhaps as carefully laid as might have been expected. And I have, in my whole period at the BIS, and if not before, been very concerned about the way in which monetary policy has been conducted, what I call the unnaturally easy, ultra easy monetary policy that's really sort of prevailed from the late 1980s, really, and has become ever more ultra easy as we've gone through the great financial crisis, the negative interest rates, the forward guidance, the quantitative easing, the yield curve control, all that stuff. I can understand the rationale, but it did strike me, and this goes back well over 20 years, when I was at the BIS, it did strike me and my colleagues at the BIS that maybe against the short-run benefits following these kinds of policies, as it were the one-period model, this is going to do us some good today, that one ought to take into account more carefully the fact that these policies might have more negative implications over time. And not least of which, of course, is the buildup of debt, so that if you're using, you sense that you've got a shortfall in aggregate demand, and so you want to lower interest rates. And all that does is it basically induces people to take spending that they might have done in the future and bring it forward to today. But if you're going to do that, for anybody who's sort of income constrained, then the only way you can do that is by taking out debts to allow you to get the money to be able to spend today. But then you say, but now the policy works through increasing debt. But of course, next period, people have got even higher debts. People that have got even higher debts going forward are less likely to spend more money. So that in a certain sense, taking out debt as a response to lower interest rates creates a headwind, as Alan Greenspan would call it, against future spending. So that in some longer run sense, the policy is almost counterproductive. And then in addition, you have to raise the question of very easy money could easily have all sorts of other unintended consequences. And many people have pointed out that easy money pushes up asset prices, and assets belong mostly to the wealthy. And this raises the question of what they call financial dominance, which is that the central banks now become afraid to raise interest rates or to maintain interest rates at high levels, because they know that the society, the private society, is already so heavily indebted that if they keep the interest rates high, the bankruptcies start to mount, and all of a sudden you get a problem that you can't control. This is what Irving Fisher back in the 1930s referred to as the problem of debt deflation. Okay? And this leads to a deflationary outcome. But to make it even more complicated, it's not just the private sector that's got this huge overhang of debt that has been generated by ultra-easy monetary policy. The public sector has got this huge overhang of debt as well. Okay? And in recent years, you think about the Truss affair, you think about some of the stuff going on in the US Treasury market. For the first time in my memory, and it's very long in the central banking, people are starting to talk about whether the government can afford to pay the burden of debt service that's now associated with the level of debt.
And that is a very interesting point because in 2025, if I'm not mistaken, the serviced debt that comes to expiration of all the issued treasuries in the US is about to hit $10 trillion. And if we look at that chart, it's a one huge spike that is this year. The pressure is on in 2025.
Yeah, I think there's going to be a lot of concern. And you certainly hear it being expressed in the United States. You've got full employment, and the deficit is still 6%. And CBO projections are for almost a doubling of the debt to G&E ratio over the course of the next 50 years. These numbers are truly unsustainable. And the problem, of course, with fiscal dominance, if you have persistent use of easy money to stimulate demand, you get a big increase in private holdings of debt, okay, which obviously includes the households, corporates, and all of the financial institutions that have lent money to those people. Okay, the whole thing becomes fragile. And the real worry is that if the central banks keep interest rates at a high level, or higher for longer, that there will be a lot of bankruptcies. And you can get into a situation like we got into in the 1930s, which Irving Fisher famously referred to as a debt deflation, which is a deflationary spiral, which can become extremely dangerous. But when you think about the fiscal overhang, now it's the government that's got a big debt problem. Okay? Debt levels, portion of GDP, very high, interest rates higher for longer, higher debt service. Debt accumulates, the miracle of compound interest, and all of a sudden the government has got a problem. So what does the government do in those circumstances? They can't sell the debt. Okay, just think about what the Treasury, U.S. Treasury has been doing in recent years. Okay, you can't sell longer debt, so you start issuing Treasury bills instead. Okay, which is the next best thing to overnight money. Okay, so you start selling short-term debt. The real worry is that people then look at that and say, the government can't issue debt in the amounts required to service the debt, so they're being forced more and more into the central bank. And we all know what that means is more inflation. And I'm out of here. Okay, I'm not going to buy that stuff, right? And then to the extent that the private sector refuses to buy the government debt, the government is obliged to go still more into the central bank. And the outcome of that is a Latin American solution, which is hyperinflation. So you want to think about that. You've got a private sector problem that's going to wind up with deflation. We've got a public sector problem that's going to wind up with inflation. Now, which could it be? And the answer in the real world, as we know it, where the economy is a complex adaptive system, is you can have multiple equilibria. It could go one way, or it could go the other. My own view is probably it'll be the deflationary threat in the first instance, and governments, as always, will say something must be done, and the something that must be done is to print the money, and you'll wind up in the longer run with an inflationary outcome. These are the kind of worries that emerge when you've had a long enough period of this kind of policy. And of course, there are other concerns as well, one of which, this goes back to the 1920s, 1930s, is Hayek's concern. This is not a Keynesian concern. Keynes is mostly concerned about the demand side of the economy, whereas Hayek was mostly concerned about the supply side of the economy.
So just to interrupt you in here, it's two different schools of economics. One is Keynesian, and the other one is Austrian school of economics.
Sort of school of thought. And in a nutshell, and I don't profess to be a great theologian of economics, But in a nutshell, Keynes was mostly worried about the demand side, and Hayek was mostly worried about the supply side. And both of them, I think, have legitimate concerns. And Hayek's worry was what he used to call malinvestments, that if you have very low rates of interest and people can get a hold of funding very easily, they will wind up doing a lot of really stupid things. And you will wind up with a lot of capital that might have been productive capital had people thought about it enough, but they didn't have to think about it enough. And so the money was invested in something that will never earn a reasonable rate of return. So that capital, wasted. In a sense, is wasted. Mm-hmm. Okay? And I think, looking back over the last 20 or 30 years, there's ample evidence of that kind of behavior. Many industries, for example, where the business model was not making profits, the business model was getting market share, so that in the end you would wind up to have a dominant market position and you'd basically force out all the others, and in the longer run you'd get monopoly profits. I always thought that was a bit of a silly sort of way to think about it, because in the end you'd ask the question about, tell me again, where are the regulators? You know, you've now got a monopoly position in this market and the government is going to live with that? I always found that a bit odd, but that has been the way things have been done for many years. So I think we have problems with ultra easy money. We have problems that emerge on both the demand side and the supply side. And I don't think either of those things are particularly healthy or conducive to healthy economic growth over time.
And that's an interesting point you raised here, because there's like this relationship of interest rate and GDP growth. So a low interest rate would stimulate a higher GDP growth. That would be the classic way of seeing it.
Yeah.
And some experts, like Professor Werner, I'm not sure if you're familiar with him, who looks at the quantity theory of credit, would explain and say that what you just underlined is that the creation of unproductive credit through low interest rate actually hampers and slows down GDP growth.
Yeah, on the supply side. I mean, if you want to suggest that you have got a significant amount of malinvestment, okay, and investments that have been induced to go into areas where they can't really make longer run profits, then the capital is gone. And if you go back to the standard kind of production kind of function, you know, where output is a function of capital, labor, land, you got less capital. And so you got less production. I'm already worried that there are a number of factors that are going to lead to a more inflationary future than we've had in the past. And to add to those factors, we have what I call the heritage problems. Okay, and heritage problems are, I'm thinking about things that will constrain growth going forward. Heritage problems are all the infrastructure that government should have done, all the maintenance on infrastructure that government should have done, and they didn't do it because it was a quick way of saving money and cutting the deficit. Okay, big mistake. Heritage problems, all this malinvestment. Okay, big mistake. And the third thing that I think, again, in terms, it's sort of a heritage problem, is I actually do really believe that you have hysteretic effects in the real world, that if you have a serious downturn, that you will wind up bankrupting a lot of capital that might otherwise have been productive, and that, you know, deep downturns, that they have costs that last, in a way, last forever. When you look at sort of, what's the word, projections, let's say forecast growth, implied government deficits, they all start off with the assumption that the growth is sustained at previous levels forever. And I guess what I'm suggesting is that's a bit of a naive assumption.
It's a fallacy of the past.
Yeah, when you look at the future, there will be ups and downs. And the downs always have a semi-permanent cost to them. Syrah and Saxena I've written a number of articles. These are two. One of these women used to work for me, actually, at the BIS, Saxena. She's now with the UN. But they have written 2 or 3 articles about this that I think are pretty compelling, that downturns always have a kind of permanent cost to them.
Sorry to interrupt this episode, but I'd like to tell you more about what we do at GoldRepublic. At GoldRepublic, we provide physical gold, silver, and platinum, fully insured, fully in your name, fully allocated, in top-tier vaults, securely saved in Amsterdam, Zurich, and Frankfurt. No paper promises, just real ownership, full transparency on your name. We are fully regulated and conduct regular independent audits of our vaults with more than 700 million euros of precious metals under custody and 70,000 investors that trust us in the last 15 years. Our top-rated app gives you full control. Track live prices, explore detailed charts, and buy or sell in just a few taps. Whether you're hedging against inflation, currency risks, or financial stability, at GoldRepublic, we offer real assets to safeguard your generational wealth. If we look at the way central banks used to handle downturns, recessions, in some cases depressions in the past, prior to 1971, there was like a quite substantial laissez-faire that was maybe not the case anymore often, like entering the 20s, the 30s, where central banks were allowing recessions, were allowing the fact that the economy would have some downturns. But in the case of politicians, not allowing it and thereby intervening through central banks to prevent that. And these boom and bust cycles then have only been increasing, and since 71, the pegging of gold, that at least was kind of a form of a break, monetary break, to calm down any out of proportion kind of risk.
I totally agree with you. I've advocated for ages and ages that little recessions are. This goes back to Schumpeter and Hayek and all these Austrian kind of people with whom you can see I have a certain sympathy. I actually wrote an op-ed for the Financial Times in 2008 or 2009, I think, and the title it was given is "Some Fires Are Best Left to Burn Out," and I used forest management as a kind of analogy. That, you know, you get little fires and you burn out the underbrush, okay? And that's a good thing. And I use the example, actually, of in the United States, they used to only put out forest fires that were man-made. And then sometime, I can't remember, in the 40s or the 50s, I think, they decided to put all the fires out. And then in I'm making this up now, I can't remember really, I think it was around 1980 something, there was a fire in Yellowstone Park, and the point was they couldn't put it out. It's a bit like what happened in the Palisades. You know, there was just so much combustible material, they couldn't put it out. And they burned 3/4 of the park. And so, in retrospect, it was a mistake to have not let the little fires burn. And I feel the same way about recessions, that they're a way of cleaning out, you know, people have got debts and they go bankrupt. Okay, so it's a little recession and you just clear out the underbrush. But the way we're doing it at the moment is you never let the debts, we never clear out the debts. We always have the safety nets now, including the safety net of lower interest rates, to just sort of sweep everything under. Sweep the underbrush under the underbrush, and it just accumulates and accumulates. And this is the origin to the problem. And I have been writing too in recent years, talking about complex systems, that the economy is a complex system nested in other complex systems. And if one system goes wrong, then you can expect the other system to start going wrong. And my big worry has been the economics is going wrong. And this has got all sorts of political implications. And again, I mean, back to the 1920s and the 1930s, one thinks about Germany, there's a lot of issues here that have to do with the dangers of get a really, really big recession. a really, really big crisis, this is bound to have political implications. Whereas a little recession, you just bounce right through it. So again, it's back to the short-sightedness and the unwillingness to take a little bit of pain in the interest of avoiding still more pain going further down the road. And we don't seem to be very, well, Jean-Paul Juncker put it brilliantly a couple of years ago. And what he said was, I think, quote unquote, of course we know what to do. What we don't know is how to get reelected after we do it. And so in the end, the unwillingness to take that political pain leads to people doing stuff that in the end will cause them even more problems than allowing, the small recessions to unfold.
And so if we look at it then in this sense, is that we could compare now the Palisade fires in LA with like the current monetary system, is that those fires were unextinguishable. The
worry is that you get to a point where you do find, right? The way that I would put it is that monetary policy works to stimulate things until it doesn't. And when you go back over the course of the last 30 years, what you see is that the monetary easing has been of a magnitude and a speed that is steadily sort of getting bigger. Okay? And it's because each time you've done it, you have to lean even more heavily because of the problems that you yourself created by your previous policy. And the logic of it is, in the end, it won't work at all. And that's not a place that you want to be. But it may be a place towards which we're heading.
When is that moment really going to be apparent? What are the signals that you would be looking at, and what would be, most importantly, the consequences?
I said the game was over in 1995, the Asian crisis. I said, we've put that behind us. The smart money is now going to get smarter, and we will not have any of this kind of nonsense again. And the money left Southeast Asia, and it went directly to Brazil and Russia. And the capacity of the central banks to pull this iron out of the fire over the course of the last 30 years has totally amazed me. And if you said, what's the biggest professional mistake that you've ever made? It was the repeated mistake of not seeing that they could do it again. And I'd be very hesitant at this point to say, well, now is the time. I've been wrong so many times in the past, but the logic of it is impeccable.
The timing is wrong.
Yeah.
And as a famous say is the markets can go longer exuberant than you can become solvent, you can remain solvent.
Absolutely.
And that is obviously like the classic.
Well, I thought you were going to use the line that I remember when I was in charge of the forecast at the Bank of Canada. The line was, you can give them a number or you can give them a date, but you must never give them both a date and a number.
Talking about forecasts, I think a lot of the forecasts that the metrics and the data that you use is obviously based on inflation, CPI in the US, and consumer prices all across the board are measured in different methodologies.
Yeah.
And I've come to interview many different people who have criticism based on the way those methodologies are done, and basically, long story short, think that those numbers are not real, or that they are basically suppressing the actual inflation. And famously, there's John Williams, I think his name is, who is behind Shadow Stats, who for many years was showing what he believed were the real inflation numbers, and that were on a average between 5 to up to 7% of a difference, but using methodologies that were developed in the first iterations since the 70s. And since then, I think the Fed in that particular case has changed its methodologies of calculating CPI over, I think, 7 or 8 times. What is your take on that?
I haven't really thought about that as an important issue. I do know that many central banks have changed, well, not many central banks, many statistical agencies have sort of changed their methodology over the course of the years. I know that different central banks tend to focus on different measures of CPI. I know that there are some people who suggest quality adjustment sometimes is overestimated and is keeping the measured level of the CPI below what is the true measure of what's happening to prices. I wouldn't consider myself to be an expert on those areas. I think a more important debate, and it's been raised by Charles Goodhart and many others, is whether one should really focus just on currently produced goods and services, or whether you should somehow be including asset prices into CPI as well. And I have rather more sympathy to that view, without saying that I sign on to it. But the idea that easy money pushes up asset prices, I think is almost indisputable. And that in itself has got a lot of problems, not least of which is it provides more collateral for people to take out more debt. Rich people tend to have more assets than poor people. So it tends to drive a wedge between those with wealth and those without. There's all sorts of things that I could see sort of pointing in the direction of you really should be taking asset prices into consideration when making your monetary policy decisions. Mm-hmm. But as you know, I mean, Ben Bernanke, I think it was in 2010 when they introduced QE for the second time, basically looked upon higher asset prices as being part of the transmission mechanism that would get you the increase in aggregate demand that the policy was designed to provide. So that it went from lower interest rates to higher asset prices to more wealth to more spending out of wealth. You know, I remember as a graduate student, the typical equation was C, consumption is a function of, income, plus 0.04 times wealth. That was the equation. And that was what he seemed to be leaning on when that increases in wealth were a good thing. Even though when you thought about it, it was just all paper.
And it also is a lot due to the Cantillon effect, right? The proximity of certain institutions or players to having that cheap or almost free borrowing cost.
Yeah. Well, that's what Hayek was worried about, mm-hmm. was that the people who had easy access to the credit would be the people who would get the benefit. In the end, it would push up prices to the detriment of other people, but the people who got in first would, as the expression goes, come out like gangbusters. They'd do just fine. Thank you very much.
I think it's also like a good context when we look at asset prices. To some commentators, like Luke Groman, for example, calls the appreciation of certain assets like gold in that respect a fire alarm, like a way that signals that the system is dysfunctional, because more and more investors believe that gold is a safe haven that needs to be owned in case of financial distress and a dysfunctioning monetary system. Yeah. How do you perceive that?
Well, I think when you look at the price of gold over the course of the last 2 or 3 years, it certainly is consistent with that hypothesis. Now, that's a very short time period, right? The last few years. But it is consistent with that hypothesis that people are becoming a bit more concerned about the stability of the system, and that in that environment, there's a certain tendency to say, well, diversification in the face of uncertainty is always a good idea. And gold is something that has held its value in CPI terms or whatever, for forever. Maybe it'd make some sense to get some. So I think there's certainly consistent with that hypothesis. And certainly as you look at what's been going on over the course of the last number of years, you can see that there's a lot of concern that a lot of parts of the system appear to be, if not unstable, giving the impression that they're less stable than they used to be. And I talked earlier on about financial dominance, fiscal dominance, the prospect that things could turn pretty negative in one form or another, either inflationary or deflationary. And confronted with all of that, it's not surprising. Some people are saying, well, what is in a sense surprising is that the central banks themselves, a number of central banks, okay, not a large number of central banks, but a number of central banks have been deciding to increase their holdings of gold. And in a way, as well-run private institutions, that makes sense. Everybody else is worried about uncertainty. Well, we're worried about uncertainty, so we're going to buy more gold. But from the perspective of central banks as public sector institutions, it doesn't really give across the right signal, does it? Like, I'm the central bank, and I'm in charge of stability, and I'm buying gold.
It's contradictory.
Yeah, there's a fundamental contradiction here. I'm in charge of stability, but I don't think I can deliver stability, so I'm going to buy gold.
Is it, you think, embarrassing for central banks to admit this?
Well, I think it's always embarrassing for everybody to admit that, can I say, they've contributed to a path that, as it turns out, might not be the optimal one.
And if we look at what you think is going to be an inflationary period in the coming decades, and you said you wrote a lot about it also recently.
Yeah.
And that has to do with commodities. What's your outlook on that?
What I've written is that I think we're making the transition now from what I call an age of plenty to an age of scarcity. And what I mean by that is that over the course of the last 20 or 30 years, the global economy has been subject to a lot of very positive shocks, supply shocks, that have been basically driving down inflationary pressures. So you had sort of globalization, and I'm thinking in particular about China, India, Eastern Europe, all came into the kind of market global trading system. So globalization has been a powerful disinflationary force. The demographics, a friend of mine, Charles Goodhart, who's my first boss at the Bank of England, he and his colleague have written a book which is called The Great Demographic Reversal, that basically talks about some combination of the globalization, demographics, urbanization, and the baby boom in Western countries. All of which have contributed to a major decline in the dependency ratio over the years. Then you've got you had a very benign energy situation, where there are huge increases in the demand for energy that were met almost, aside from the 70s, early part of the 80s, met almost seamlessly by increases in the production of fossil fuels. Then you've got sort of the relentless search for efficiency. Corporations, it was all about efficiency. And then you had, so that's all on the supply side. And then on the demand side, so positive supply side, and on the demand side, you had the peace dividend. So you didn't have to do all that spending on the military. The demographics, again, very helpful, sort of, young people, good health. They didn't have to spend so much money on that. And now everything's going into reverse. So globalization is turning into deglobalization. China, we don't know how bad it's going to get. It could be a small space with a high wall, or it could be a huge space with a low wall. We don't know. So globalization is under threat. The demographics is all going into reverse. Population of working age is already declining in Korea and Japan and China. Okay, and in Europe, we have a big demographic problem coming down the road. The fossil fuels, the easy expansion of production of fossil fuels coming to an end because of the carbon budget. There's going to be big problems in sort of bringing electrification online. I think we're moving from an age of fossil fuels to an age of metals. You know, there's just so many metals you need for electrification and for moving to this different way of producing energy. Takes, 12 to 15 years to build a mine. Start saying to yourself, where's all this stuff going to come from? Efficiency, search for efficiency now increasingly replaced by resilience. Okay, we saw what happened during COVID, supply chains, everybody. So McKinsey has estimated like 80% of all of the companies that they survey are in the process of diversifying. You can see it in the trade statistics. You know, people diversifying away from China, but now they have to build a different supply line someplace else. Okay? This is all expensive in terms of investment. The military thing has gone into reverse. Okay, we can see it already. I mean, the UK is under pressure, Europe's under pressure, you know, Trump, all sort of posturing, but there's no doubt that there will be huge pressures for more military spending. The demographics, as I say, is turned around. One part of that is going to be health. Okay, old people get sick. You know, they're very, what is it? Sort of, like I read someplace that 90% of all of the money that you spend on medical care will be spent within 1 year of your death. Okay, old people are expensive. So all of this stuff is just like a huge mix of negative supply shocks, replacing the positive ones, and positive demand shocks, replacing the negative ones. Okay? So you put it all together, and to me, it's an inflationary future, a more higher interest rate future. But we've already said a higher interest rate future. What about fiscal dominance? What about financial dominance? These problems that weren't problems before now, I think, are going to become really important problems. So central bankers, you know, they thought they had it tough because they couldn't get inflation up in a world that was fundamentally disinflationary. Well, now the problem is going to be, how do you keep inflation down in a world that's about to become fundamentally more inflationary? That's going to be the challenge.
How do you reconcile the ability of central banks to fight inflation while not being able to raise interest rates or keep interest rate high for long?
In the end, if you have worries about fiscal dominance, in a way, issues of independence are totally meaningless. Because the point of the matter is, if you have a situation that threatens fiscal dominance, tightening monetary policy is inflationary, not deflationary. That's the thing that's hard to wrap your mind around. But the world, once you get beyond that tipping point, the world actually works in a very different way. And if that is the case, and it will be interesting to watch Japan in this regard, because I think this might be the sort of the le fer de lance about what happens, is that it is not impossible. And Ken Rogoff and Carmen Reitheid have both said this too, that we will go back to a world in which the threat of fiscal dominance will be met by the reality of financial repression, which is that you'll have a situation where the interest rates will be held down, various administrative means, capital controls, who knows what, okay, all on prudential basis. Okay? Interest rates will be held down while inflation will be allowed to rise to a moderate level. And it doesn't take too many years, as we saw in the immediate aftermath of World War I, where the debt overhang just is gradually eaten away. And after 5 or 6 years, it's sort of back to business as usual, but obviously at a much higher level of the price level. So if we look at then the way the collaterals are organized, and with the coming of implementation, or the already existing implementation of Basel III, with one of its predicaments of being gold coming back as a tier 1 asset and a high quality liquid asset, is this going to change fundamentally the way collaterals are then being perceived, and then in that sense kind of a revival of gold as a more centric piece of the monetary system in the coming years in this inflationary period? It certainly could be. It certainly could be. I don't profess to sort of understand enough about the way modern collateral works, But clearly, if the central banks are making, or some central banks at least, are making gold a larger proportion of their reserves, and gold is now sort of considered as a tier one asset, it's obviously going to change. It's obviously going to change something. But my recollection is that Basel III still has a lot of shortcomings. Not only individual bits of it are sort of questionable, but the integrity of the whole package has been called into question. I think the biggest worry about banking regulation has been that it's actually forced a lot of activity outside the banking system. So we now have a non-bank shadow banking system, which is bigger than the banking system. Now, it varies across countries. I mean, the market-based stuff is much more important in the US than it is in Europe. But the non-regulated financial system, including the markets for bonds and debt and that kind of stuff, is now bigger than the banking system. And the problem is that large parts of it are really very non-transparent. So you have a world in which you don't actually know who's doing the lending, and you don't know who's doing the borrowing. And so when you start saying things like, what are the implications for financial stability of higher interest rates, the answer is you have no clear answer. And the Financial Stability Board has been repeatedly calling for more information, but I'm not sure that a great deal has actually been done to provide more information. Obviously, it's a very tricky business because all sorts of people say that information is proprietary information, and I'm making money on the basis of keeping that information to myself. So it's not the easiest thing in the world. But as I say, the Financial Stability Board has been repeatedly requesting more information about what's going on in the non-regulated shadow banking system.
You've been telling me beforehand that you actually were the team that was part of selling all the gold that was left in the bank of the Central Bank of Canada. What led to this decision back then?
Well, the gold didn't belong to the bank. Oh. The gold belonged to the government. Okay, so I think I made the reference before to a monkey and an organ grinder. That the Central Bank, the Bank of Canada, was the monkey, but the organ grinder was the Department of Finance. And they made a decision in finance, I mean, obviously in consultation with private sector financial people, etc., that gold is a non-earning asset and one whose price had not been going up. It was probably something that didn't belong in the reserve package of a central bank, of the government. And so they instructed us to sell it all, and indeed we did. And as you know, there was so much pressure for central banks to sell, no, not for governments to sell their reserves. In many instances, the central bank actually held the reserves, that there was an agreement reached on restraining the sales of gold by central banks. I think that agreement was arrived at in 1999, I think, and it was repeatedly renewed 3 times until 2019, when it was not renewed. And the reason it was not renewed was because at that stage of the game, there was absolutely no evidence that central banks wanted to sell more gold. There was no worries about overselling, as it were, and pushing the price down, which is what they'd been worried about before. You know, rush to the exits would push the price down. That everybody had looked at it and has seen what was going on and basically said, I think the price is going up and I want some part of that.
Do you believe that there is a chance, maybe, and that's something we investigate also in the documentary, for not necessarily a gold standard, but a gold-backed system, or a more heavily gold-backed system, a revival?
Well, there's talk of the BRICS amassing gold and using it as it were a basis for a new currency that would be actually related to gold, at least in part. And I think that will be a very long and a difficult path. But it is interesting that some of the central banks that have been amassing gold are also principal players in the BRICS group. And they have, many of them, expressed the clear wish to somehow diversify away from the use of the US dollar. A desire which I think has been stimulated by the repeated use of the dollar as a weapon, against Iraq way back when, Russia more recently, and not just the fact that the Russian reserves were frozen, but the fact that many banks were kept out of the SWIFT system. And so coming up with an alternative system, settlement system, perhaps based on a different currency, it seems to have attraction to those people. Now, the technical and other challenges that they face are pretty formidable. The people that currently use the system, the people that use the current system, there's always a great tendency to want to preserve it, because it's the system that you know, and I won't say that you know and you love, but it's the system that you know, and you're happy with using a system that you know.
There was also recently the BIS that was in conjunction with Saudi Arabia and China conducting a pilot of the mBridge, which then, for I guess political reasons, the BIS withdrew from. Is that maybe the beginning of such a system?
Well, the mBridge thing, Augustin Karsten, who was then the general manager of the BIS, he basically said that it wasn't a withdrawal for any political reasons, that that the BIS contribution had made they'd made their contribution to the project, and they wanted to use the resources elsewhere, and so they pulled out of it. But my understanding is that the fundamental technology behind the mBridge project was developed really by the People's Bank of China, together with the Hong Kong Monetary Authority. And so I dare say that they will continue sort of working on this particular technology. And they may or may not be able to bring it to, to fruition as a working system. It's still sort of it's just sort of out of the model stage.
All right, I think we've reached the end of our time here, unfortunately, Bill, for today. I hope I might be able to talk to you in the future as well. But I appreciate all the knowledge you shared with us, and really grateful for the time you've given us.
Oh, it's been a pleasure. Thank you very much for very thoughtful questions.
Thank you.